All right, let's dive into the latest report from a true financial titan, JPMorgan Chase. Now, I know it sounds like just a bunch of numbers, but trust me, it's way more than that. It's like a sneak peek into the health of the entire economy. So, the big question is, what can one company's report really tell us about where we're all headed?
And that's a fair question, right? Why are we focusing so much on just one company? Well, because when that company is one of the biggest banks on the planet, its performance acts like a massive economic signal. The amount they lend, where they're investing, even their mood about the future. It all gives us clues about what's coming next for everyone.
And just to give you a sense of the scale we're talking about, look at this number. Nearly $4.4 trillion in total assets. That's trillion with a T. I mean, it's just a mind-boggling number. When you have a footprint that huge, your story, in a lot of ways, becomes our story. Okay, so let's get into the nitty-gritty, the full year results for 2025. And really, the whole thing boils down to a tale of two very different numbers, and a pretty interesting puzzle.
So here's the paradox right up front. 2025 was a record-breaking year for the amount of money JPMorgan Chase brought in the door. An absolute banner year for revenue. But when you look at the actual profit they got to keep, the picture gets a little more complicated. So, what's going on here? First, the good news for them. Their managed revenue, which is basically a wide view of all the money they generated, grew by 3% to over $185 billion. That's a clear sign that the core business is humming along and growing. No problems there. But then, here's the twist. The net income, the actual bottom line profit, it actually went down by 2%. Now, it's a small dip, but it's a really big deal when your revenue is hitting all-time highs. So they made more money, but somehow kept less of it. The obvious question is, where did it go? Now, to see if this is just a blip or a real trend, we can zoom right in on the last 3 months of the year, the fourth quarter. And what you find is that this pattern of record revenue but softer profit, well, it actually got even more dramatic at the end of the year. This simple table just nails the point home. Look at that. In Q4, revenue was up a really strong 7% compared to the year before, but net income down 7%. That widening gap between money in and profit kept, that leads us directly to the single biggest reason for this whole story. So let's solve the mystery. A huge piece of this puzzle isn't a problem at all, but a massive strategic bet the company is making. And it's a bet that involves one of the most famous brands in the entire world.
So, back to that question. Where did the profit go? It wasn't lost. It was spent on purpose. The company decided to set aside billions of dollars to buy the Apple credit card portfolio. This is a huge investment they're making in their future.
And here is the jaw-dropping number. The bank set aside $2.2 billion in a single quarter just for this deal. That one move had a massive impact on their bottom line, and it's what they call a significant item in their report. It's the smoking gun. Now, to really get this, we need to quickly talk about what a credit reserve is. The easiest way to think about it is as a bank's required rainy day fund. Before they can even start lending to new customers, like all those new Apple card holders, they have to put a chunk of money aside just in case some of those folks can't pay their bills back. It's a rule, and it's also just smart business.
And the report is crystal clear here. This $2.2 billion reserve was built specifically to prepare for taking on the Apple credit card portfolio. It is a textbook example of taking a short-term financial hit in exchange for what they hope will be a massive long-term gain.
So that pretty much explains 2025. But this big Apple Card deal, it's really just one piece of a much larger strategy. And when you look at their own outlook for 2026, the theme is obvious. You gotta spend money to make money.
Looking ahead, the company is basically telling everyone that this spending spree is going to continue. Their own forecast for the coming year shows a really clear strategy of investing heavily across the business to hopefully spark future growth.
Okay, so first, let's look at their core lending business. They're projecting their net interest income, which is basically the profit they make from loans, to be around $95 billion in 2026. A massive number. But here's the kicker. They're also projecting to spend about $105 billion. You see that, right? They are literally planning to spend more money than that entire massive revenue stream brings in. This isn't an accident. This is a very deliberate investment push.
And this isn't just random spending. The report actually breaks down where that cash is going. They're investing in people, hiring more bankers and advisors. They are pouring money into tech and data analytics. They're cranking up their marketing budgets, especially for credit cards. This is a broad, aggressive investment in growth. Plain and simple.
So we end right back where we started. We care about this stuff because it shows a clear, bold strategy from a financial giant. JPMorgan Chase is betting big. They are spending heavily today on things like the Apple Card portfolio and new tech, all with the expectation of getting much bigger returns tomorrow. The big question, though, the one everyone is asking, in an economy that a lot of people feel is cooling down, will this massive investment actually pay off?